They call it a rate decision. But for millions of Americans, it's really a verdict, one that will decide how comfortable or how fragile their future feels. Behind closed doors in Washington, the Federal Reserve faces a choice with no easy answer. Keep rates high and risk strangling the economy just as it's catching its breath. Cut them too soon and risk letting inflation rise from the ashes. JP Morgan calls this moment the most delicate balancing act since the 1980s. Morningstar notes that the U.S. economy remains resilient but losing altitude. Mortgage holders, retirees, savers, investors, everyone's portfolio now lives in the Fed's shadow. Because the next move from the central bank won't just steer markets, it will quietly decide whether your savings grow or your retirement plan starts to run out of time. When most people think of the Federal Reserve, they imagine something abstract, a room of serious faces adjusting numbers on a screen. But what happens in that room quietly shapes every American's financial life. Every mortgage payment, credit card bill, and retirement account is tied to the interest rate pulse the Fed controls. For almost 2 years, that pulse has stayed unusually high. The central bank kept rates elevated to cool inflation after the biggest price surge in 4 decades. It worked. Inflation dropped sharply from its peak, but not without side effects. Growth slowed. Corporate profits began to flatten. The stock market turned nervous, and ordinary savers, once earning pennies on their deposits, suddenly enjoyed 5% yields they hadn't seen in 20 years. That created a strange divide. Savers celebrated higher returns. Borrowers groaned under heavier debt. The same policy meant 2 different realities. A reminder that monetary policy is never neutral. It gives with one hand and takes with the other. Now, the Fed faces a harder question. What comes next? The data tell 2 stories at once. The labor market still looks strong. Unemployment hovers near historic lows. Yet hiring momentum is fading. Job openings are shrinking. Wage growth has cooled. The consumer spending engine, which powered the U.S. through global slowdowns, is beginning to sputter. Morningstar's latest economic overview calls it a glide rather than a crash, but glides can end abruptly if confidence disappears. Inside the Fed, that tension has turned into debate. Some policymakers argue that holding rates high for too long could tip the economy into unnecessary pain. Others fear cutting too soon would undo years of work, inviting another wave of price pressures. The difference between those 2 outcomes could hinge on a single quarter-point change. To understand why that matters, imagine the financial system as a vast network of gears. The Fed's policy rate sits at the center. When it moves, every other gear, from bond yields to home loans, adjusts its rhythm. A higher rate means costlier borrowing. That discourages spending and cools demand. Lower rates do the opposite. They encourage risk, investment, and credit creation. The art of central banking lies in adjusting the gears without snapping the machine. Right now, those gears are grinding in unusual ways. Corporate America refinanced much of its debt when money was cheap, so the immediate damage of high rates is delayed. But as older bonds mature, firms will have to refinance at double or triple the previous cost. The same logic applies to households. Millions of homeowners locked in low mortgage rates and feel untouched, but first-time buyers are frozen out, and credit card balances have reached record highs. Student loan repayments are restarting, car payments are climbing. It's the kind of slow building strain that doesn't make headlines until something breaks. JP Morgan's economists describe this phase as a policy plateau. Rates are not rising, but they're not easing either. In that stillness, pressure accumulates. Businesses postpone expansion. Startups struggle to raise capital. Venture funding contracts. Even government budgets feel the squeeze as interest costs eat into tax revenues. The longer the plateau lasts, the more fatigue spreads through the system. Meanwhile, markets are doing what they always do when clarity is missing: guessing. Every speech from a Fed official, every jobs report, every inflation print sends waves across Wall Street. Traders build scenarios, then abandon them days later. The result is volatility without direction, a market that wants certainty and keeps finding ambiguity instead. For investors nearing retirement, that uncertainty is dangerous. Bonds, once the safest anchor of a portfolio, lost value during the rate hike cycle. Equities recovered from their lows, but remain sensitive to any hint of a downturn. Cash yields look appealing, but they won't stay high forever.
The temptation is to wait on the sidelines, yet doing nothing is also a decision, one that inflation quietly erodes. This is the human face of macroeconomics, the retiree watching portfolio values fluctuate, the young family delaying a home purchase, the small business owner recalculating loan payments. Each of them lives inside the ripple effect of central bank caution. For them, the Fed's next move isn't an academic question, it's a monthly reality check. Behind the curtain, the Fed studies a mountain of indicators: core inflation, consumer sentiment, industrial output, bank lending surveys. Many point to moderation, not crisis. But there's a deeper unease, the sense that the tools built for past decades might not fit the present. The global economy has changed. Supply shocks, demographic shifts, and digital finance have altered the way inflation behaves. Monetary policy still matters, but its transmission is slower, more uneven, and sometimes unpredictable. That's why economists call this moment a test of credibility. The Fed must convince the public that it can maintain stability without choking progress. Confidence once lost is expensive to rebuild. The early 1980s taught that lesson when the fight against inflation triggered a deep recession. No one at the Fed wants to repeat it, but no one wants to lose control of prices again either. And so the institution walks its narrow bridge, measuring each step. Markets crave a clear answer, higher, lower, or steady. But the Fed prefers ambiguity because ambiguity keeps options open. That tension will define the next cycle. It's a contest between patience and pressure, between what the data show and what people feel.
For the average American, the practical question remains the same. What should I do now? Hold cash while yields last? Lock in a mortgage before cuts lower rates but raise prices? Move out of bonds or double down on them? These are personal choices built on public policy. When the next announcement comes, it will sound like a technical adjustment. Yet behind that technicality lies a story about risk, reward, and the fragile psychology of trust, the currency that ultimately decides whether an economy thrives or stalls. To understand how much is at stake, look at the invisible threads connecting interest rates to almost every corner of personal finance. When the Federal Reserve raises or lowers its policy rate, it doesn't just influence banks, it changes the emotional temperature of the entire economy. Confidence, fear, and greed move with it. A single percentage point can shift trillions of dollars between winners and losers. For retirees, the past 2 years have been a strange mix of relief and anxiety. After a decade of near-zero yields, savings accounts and money market funds finally offer returns that feel real again. For someone living on fixed income, 5% interest looks like freedom. Yet beneath that relief lies a trap. Those high yields depend on the very same high rates that threaten the value of long-term investments. When rates eventually fall, the cushion shrinks overnight. That's why financial advisors keep repeating the same quiet warning: don't mistake temporary yield for permanent security. A retiree who moves everything into cash today might feel safe, but in the next cycle, those returns will vanish while inflation slowly erodes the balance.
Long-term stability still requires risk, and risk always circles back to the Fed. Consider housing. Mortgage rates have doubled from the easy money era. Homeowners who locked in at 3% are holding tight, creating a nationwide freeze in supply. Buyers face smaller choices and higher prices, even as demand cools. Builders hesitate to start new projects because financing costs eat into margins. It's a feedback loop. High rates reduce activity, reduced activity supports prices, prices feed inflation expectations, and inflation keeps rates high. No policy line exists in isolation. Every lever pulls another. The same tension appears in corporate America. For years, cheap borrowing encouraged stock buybacks, rapid expansion, and speculative mergers. When money became expensive, that rhythm changed. Companies began hoarding cash. Layoffs surfaced not from collapse, but from caution. The economy entered a phase where strength and fear coexist. Profits remain decent, but optimism is fragile. Analysts at JP Morgan describe it as late cycle behavior, the period when growth still shows up in the data but disappears in sentiment. For investors, that sentiment shift is crucial. When people believe risk is high, they demand higher returns, and that pushes down the price of assets. Bonds lost nearly a quarter of their value during the tightening cycle, the worst drawdown in modern history. Equity valuations, though recovered, now rest on narrow foundations, a handful of tech giants driving indexes while smaller firms struggle. The market is optimistic on the surface, but brittle underneath.
Morningstar's economists note that the health of the U.S. economy now depends more on consumer psychology than on stimulus or spending. Americans have money, but they're reluctant to use it. Surveys show households still describe conditions as poor, even though employment remains strong and wages are positive. This disconnect between data and feeling is the Fed's silent adversary. Monetary policy can influence prices, but it cannot force optimism. When people are uncertain, they save more, invest less, and slow the very growth the Fed tries to protect. This paradox touches retirement most directly. Pension funds rely on predictable returns from both bonds and equities. If rates stay elevated too long, bond portfolios lose value. If rates fall too quickly, equity bubbles reinflate and future returns shrink. Either path can destabilize the delicate math behind pensions, which must balance present obligations with future promises. Many public systems already face gaps widened by the last decade of low yields. The current environment, while seemingly favorable to savers, threatens to expose those long-term shortfalls. There's also the behavioral side. Each rate cycle leaves psychological scars. After the 2008 crisis, Americans feared risk and hoarded cash. After the pandemic boom, they chased meme stocks and crypto. Now the pendulum is swinging back toward caution again. Every generation learns the same hard truth in a different language. Central bank policy might guide the economy, but emotion drives markets. A single Fed sentence can erase months of investor confidence. That's why the communication style of the institution matters as much as the numbers.
Officials craft every phrase to shape expectation without committing to a path. They know traders react to tone more than text. When the chair says rates will stay higher for longer, it becomes a cultural signal, not just an economic one. Borrowers postpone purchases, companies freeze hiring, local governments delay projects. The phrase becomes prophecy through repetition. Meanwhile, global factors complicate the picture. Europe's growth is stagnant, China's recovery is uneven, energy markets remain volatile. Each of these forces influences the Fed's calculus because capital flows toward the least risky home. If US rates remain relatively high, dollars strengthen, exports weaken, and multinational profits suffer. If rates drop too fast, the opposite occurs. The dollar slides, import prices rise, and inflation returns. The line between stability and chaos is narrower than ever. Inside this complexity lies the individual investor trying to plan a lifetime. Should you buy bonds now or wait for yields to peak? Should you keep money in short-term instruments or extend duration? Should you move equity exposure abroad or double down on the domestic market? None of these questions have single answers because they depend on one unknowable variable: when the Fed blinks. Every financial cycle teaches that opportunity hides inside uncertainty. The investors who thrive are not those who predict perfectly, but those who adapt quickly. Still, adaptation requires clarity, and clarity requires trust that the system works. That trust is the fragile thread running through the economy. If people stop believing the Fed can maintain balance, markets start pricing chaos instead of stability.
Confidence itself becomes the policy tool. As the debate over the next rate move intensifies, the Fed's role looks less like a mechanic tuning an engine and more like a therapist calming a patient. It must speak softly enough to avoid panic, but firmly enough to be believed. Every speech, every projection, every signal is designed to guide emotion as much as economics. The institution knows that controlling inflation is half about prices and half about psychology. Some observers call this the confidence recession, not a downturn in output, but in trust. When individuals doubt the future, they save excessively, invest cautiously, and work defensively. That mindset can slow an economy more effectively than any policy change. The Fed's next decision, therefore, isn't just about rates, it's about repairing collective belief in forward momentum. All of this brings us back to a simple question with no simple answer. How do you plan for retirement in an age where stability itself feels temporary? The honest answer is that you can't plan with precision, only with adaptability. Diversification, patience, and discipline sound like cliches until the cycle tests them. In the months ahead, those virtues matter more than predictions, because what's unfolding now isn't just another adjustment in borrowing costs. It's a test of how resilient households, markets, and minds have become after years of shocks, a slow reckoning with the price of stability itself. Every economic era leaves behind a philosophy about money. The post-war years taught Americans to save.
The 80s taught them to borrow. The tech era taught them to chase growth. Today's world, shaped by years of rate shocks and financial whiplash, is teaching a harder lesson, that stability itself is a moving target. What the Federal Reserve does next will set the tone for how the country defines safety. If it cuts too early, inflation could quietly hollow out purchasing power, shrinking the real value of pensions and annuities. If it waits too long, higher borrowing costs could freeze new investment, stall housing, and erode the value of stocks inside retirement accounts. Either way, the message is the same. Security is no longer something the system guarantees. It's something each person must build through flexibility. That idea is uncomfortable, but it also contains hope. The landscape has changed, yet the tools for resilience have multiplied. Technology gives investors real-time insight that once belonged only to institutions. Diversified index funds, treasury bills, and inflation-protected securities are available with a few taps on a phone. Households can hedge, rebalance, and react faster than ever. The power that once sat in the money Bill Hole's Ballinum marble halls is now shared in fragments across millions of decisions made daily. Still, data alone can't replace trust. The deeper challenge for the next monetary cycle is emotional, restoring faith that long-term planning is still possible. When every headline speaks of volatility and every forecast changes within weeks, people lose the instinct to think decades ahead. That hesitation has social costs.
When citizens stop believing their future is secure, they stop investing not only in markets, but in communities, education, and innovation. Monetary stability in the end is also civic stability. Policymakers know this. The Fed's public statements have begun to emphasize communication as much as policy. Transparency, forecasts, press conferences, all are designed to rebuild confidence. It's a recognition that economics is no longer a closed system of numbers, but an open conversation with the public. Credibility is earned word by word. Meanwhile, outside Washington, the slow reordering of wealth continues. Higher yields reward savers but punish borrowers. Renters face rising costs while homeowners sit on locked-in gains. Young workers shut out of the housing market turn to riskier assets like crypto or options, trying to leapfrog stagnant wages. Retirees shift between anxiety and relief as portfolios swing. The Fed can moderate the cycle, but it cannot erase the inequalities that the cycle exposes. The next few years will likely reveal a gentler inflation, softer growth, and rates that drift down rather than drop. Economists call this a soft landing, but soft landings, like any landing, still shake the passengers. The turbulence may ease, yet the memory of the storm lingers. Every investor who endured the crash in bond values or the surge in mortgage costs will carry a more cautious mindset into the next expansion. That caution will define markets as much as any policy. So, what does this mean for retirement? That quiet dream of enough stability to stop chasing the next paycheck? It means the definition is evolving.
Retirement security will depend less on one fixed yield or employer plan and more on adaptability, learning, reallocating, staying curious. The old model of set it and forget it has become watch it and adjust. In a world where the central bank must improvise, individuals must do the same. There is a paradox here. The very uncertainty that frightens people is also what creates opportunity. When rates fluctuate, new entry points appear for long-term investors. When fear dominates, valuations fall to levels that reward patience. The challenge is not avoiding volatility, but navigating it without panic. That's the quiet skill the next generation will need more than market timing: emotional discipline in a noisy economy. Beyond the markets, the Fed's decisions will shape something larger: how society values time. Low rates encourage consumption now, high rates reward patience later. For more than a decade, the world lived in the rhythm of instant gratification. The recent tightening reversed that rhythm, forcing everyone to rediscover the virtue of waning, of earning interest instead of chasing leverage. Perhaps this is the hidden gift of the cycle, a reminder that progress is not just growth, but balance. As the country moves into the next phase, the questions will remain. How low is low enough? How high is too high? How do you measure confidence before it shows up in the data? These are not just economic puzzles, but moral ones. They ask what kind of future a society wants to create, one driven by speculation or by steady building. The Federal Reserve cannot answer all of that.
It can only keep adjusting the dial, watching how each shift echoes through millions of lives. Somewhere between restraint and risk lies the path that keeps the system breathing. Each rate move will still make headlines, but the real story will unfold quietly in household budgets, investment choices, and dinner table conversations about the future. When you strip away the charts and jargon, the truth is simple. Every rate cut is a promise, every hike is a warning. Between them lies a question that no algorithm can solve. How much stability are we willing to trade for growth, and how much growth for peace of mind? The answer, as always, will decide who prospers, who pauses, and who pays. So as the next Fed meeting approaches, remember this: policy shapes markets, but perspective shapes destiny. The rate may change by 1/4 of a point, yet its meaning will depend on how you respond. Stay patient when others rush. Stay curious when others fear. In a world ruled by uncertainty, calm observation is still the most powerful form of control. Because in the end, every economy is built not just on money, but on belief that tomorrow is worth planning for. And the strength of that belief, more than any policy rate, will determine whether your retirement grows in peace or fades in hesitation.